I'm going to give an overview on what's going on in the capital markets. I'll start with the past few years, we've been doing a CEO survey where we ask all the folks who are here, we ask some folks who we invite that can't make it, what's on their mind. And so I'll share a few results there. Not the full results, but that'll be available to folks after the summit if you're interested in that. And we appreciate everyone who took the time to fill that out. I'll give an overview on what's going on in the capital markets, debt, equity, M&A, a little bit of perspective on just the healthcare market, and a few key takeaways at the end. Like John before me, I have to cover a topic that's generally pretty boring, and I have to do it and try to not put you guys to sleep right after lunch. So hopefully I've got some good nuggets of wisdom and maybe a couple of dad jokes, as Carson alluded to. So what's on our CEO's mind? Here's the demographics of the folks who answered our survey. It's I think it was right under 50. It was like 48 CEOs responded to our survey. Pretty heavy pharma services focused, almost 2/3. Therapeutics or pharmaceutical products was about a quarter. Handful of healthcare services companies and a few private equity. Predominantly private companies, 57% were private equity backed, 38 family founder owned, and 5% public. And then a nice mix of some larger companies north of 25 million of EBITDA. That was the largest grouping, about 22%, 10 to 25, 31 below 10 million, and we had a few that were less than zero. Some of those may be our tech-enabled or SaaS software-based businesses that are growing but not yet profitable. Other notable demographics, we had about 12% were bald or balding. That's just joking, but it's really important. We got a lot of great bald and balding folks out there, and I was recently voted the #1 investment banker for bald CEOs. So anyway, just kidding. We're not keeping track of that. So what is top of mind for our CEOs? This year it was all the regulatory and legislative changes and noise out there. Tariffs and AI are top of mind. We're going to talk a little bit about those, and we have a special panel on AI, or not panel, but presentation on AI later, so that's great. Last year it was capital markets, still important, but was not the top this year. And of note, inflation is not top of mind, but that does not mean it has gone away. So we'll talk a little bit about that here. So how do our CEOs expect the policies of the Trump 2.0, the Trump administration, to impact their business? It's fairly evenly split between positive and negative. And my guess is the slight lean on the negative side is a lot of our healthcare services folks, especially ones who've been hit by the cuts to Medicaid in the One Big Beautiful Bill. So I wasn't able to split this by industry subsegment, but if we can do that, we'll share that in the final report. And then, how do you expect your business to perform in 2025? And what are your expectations for revenue growth next 12 months? So congratulations, 98% of you, or of our CEOs, grew their company this year, and 76% grew over 10%. And maybe that's only the 50 who responded, and the others who weren't growing were too busy working on the business, but very, very positive results. And then for next year, I thought it was really striking that 88% expect to grow greater than 10%, and approximately 50% expect to grow greater than 20%. So that's pretty aggressive growth expected across our CEOs. And then where do you expect valuations in your industry? With 53%, so very bullish, 53% of our CEOs expect their subsegments valuations to increase over the next 12 months. And in terms of expectations on M&A activity over the next 12 months, about 2/3 expect an increase in M&A activity. And coincidentally, about 2/3 of our CEOs plan to explore M&A activity over the next 12 months. Most of that, about half on the buy side, and about 20% plan to sell. And still a third focused on organic growth. It's not quite the time for those businesses yet. This is one that I thought was really interesting. This is the last one I'm going to share on what our CEOs are thinking about. But how do you expect AI to impact your business over the medium term? And if you look here, there is no one who expects AI to have a negative impact on their business over the medium term. So I thought that was pretty interesting. And everyone, it ranges from transformational to large to small positive, pretty evenly split between those three. But I'm really excited for Matt Groh and his presentation on AI a little bit. I don't know if he's right after me or a little bit after me this afternoon. I think that's going to be really, really interesting. Okay. So what's going on in debt, equity, and M&A? Last year when I stood up here, if you were here, the theme in private equity transactions was focused on quality. Private equity was being very selective, looking for assets with strong fundamentals, could weather uncertain times. And I think at the beginning of this year, or end of last year, beginning of this year, I think we were all here. We expected a really robust M&A market for 2025. But the theme this year was a false start. We were all out there at JP Morgan in January, having meetings, thought it was going to be, maybe not quite as robust as 2021, but it felt like things were really going to rock and roll. We were going to be finally a lot of exits, but it didn't happen. And really a lot of the noise, the Liberation Day announcement in April, the tariffs, it created a lot of uncertainty. One big beautiful bill, and that uncertainty kind of threw a wet blanket on everything and spoiled the M&A party for a lot of us. And I think for some of our friends in pharma, especially with tariffs and what's happening and pricing and reimbursement, other things, there's still many more questions than answers still remain. So I'm not going to go into a bunch on policy. We had a policy expert. We had a great presentation and thoughts there. But what are our clients thinking about? What are we thinking about? What's impacting some of our clients' businesses? What's impacting deals? These are some of the things that we're looking at, and how's this playing out? How's it going to impact? So select legislative changes. I think one big beautiful bill, the $950 billion in cuts to Medicaid over the next 10 years. I think it stalled a lot of transactions, created uncertainty. The good news now is it's passed. You know what it is, and you can quantify it. So at least some of that uncertainty is gone. So the negative, a known negative in many cases for M&A and for transactions is better than the uncertainty in terms of being able to get things done. So that's top of mind. I think it's delayed a lot of exits. It's stalled some transactions for folks. But it's still top of mind, and we'll talk about that a little bit more here later. The one big beautiful bill was also beneficial for orphan drugs. It eliminated the price negotiations once you had kind of the second indication or further indications approved, and so that makes extends kind of the runway for orphan drugs. So that's really interesting, both on the pharmaceutical product company side as well as those folks involved in clinical trials, drug development, manufacturing, et cetera. And then maybe as important as what it addressed is what it didn't address, that we were a little surprised. The pill penalty, which allows for earlier negotiations after 9 years for small molecules as opposed to 13 years for large molecules, and addressing that we think is something that needs to be addressed. And then it didn't address PBM reform. That's it's a pretty bipartisan issue. We expected there to be something there. Didn't address it. So we'll see. Regulatory changes. I think we're keeping an eye on the most favored nation. You've had 2 pharmaceutical companies sign a deal with the president. I'm sure there'll be more who want to get up there and sign something with the president, and we'll see what happens there. I think this is going to impact where and how folks choose to develop their products and launch initially, so we'll see how that plays out. The reversal. One of the things that we're very interested in as M&A advisors is reversal of some of the Biden antitrust policies and the focus or targeting of healthcare transactions. I don't think it necessarily spurs a lot more M&A, but it maybe allows some transactions to go through a little easier, a little quicker, which is always great when you're trying to get deals closed. And then the ANDA priority review pilot program, I think, is pretty interesting, prioritizing generic pharmaceuticals that are developed and manufactured in the U.S. market. I'm going to call out Brandon Rockwell. He's probably an expert in this if anyone has any questions on it. Ask him before you ask me, and he'll have a lot more insight and perspective on that. But I think we talked about it a little bit before. Pharma is an easy target, but there's 2 different pharma worlds. Generic pharma is part of the solution. It's not part of the problem. And so, generics, as Banks pointed out, are cheaper in the U.S. than they are in other countries. So, we have to, support that part of the market if we want to bring healthcare costs down. So, and then just the regulatory relief to promote domestic production of critical medicines. That executive order is trying to it's incentivizing and trying to make it easier to build manufacturing in the U.S. And I think that, along with the tariffs and the threat of tariffs, is why you're seeing $430 billion in announcements since the beginning of this year. Predominantly big pharma to bring more manufacturing and onshore their manufacturing. There's a lot of other things that we're keeping our eyes on, but these are some of the big ones. So let's talk a little bit about inflation. So inflation, while it is moderated, we don't think it's yet defeated. CPI is at 2.9%, which is well above the Fed's target of 2%, and PPI is at 2.7. Both of those have been on the rise a little bit. Here at Bourne, we expect the tariffs to continue to put some upward pressure on both CPI and PPI. So we're keeping an eye on that. And we did have the first rate cut back in September, 25 basis points, first rate cut since last year. When we were standing up here last year, I think the market was pricing in 6 rate cuts this year. So we've got 1. I'm pretty sure we're going to get another rate cut in October, where the Fed is signaling signaling 2 more cuts this year. I think the market is pricing in 1 to 2, and next year 1 to 3. I think the balancing act is for the Fed. They made this cut because jobs are starting to soften, and I think it's going to be, how do you deal with jobs versus inflation? Because inflation's we're not out of the woods yet when it comes to inflation. So Banks hit on this a little bit, so I won't spend a lot of time, but rates and spreads are continuing to fall. So, obviously the rates, went way up in over 22 and 23 compared to where they were. And yields rose as well, but they peaked in 23, but they've been coming down a little bit as SOFR has come down and as the debt capital markets have opened up and supply, that's brought yields down as well. So I'll just jump right into the next slide. Year-to-date debt activity is really strong. It's already, as of 9/30, it's on track to be on par, maybe even a tad better than 2021. So the debt markets are wide open, and we're in market on a few debt recapitalizations, and there's a lot of interest, there's a lot of demand, and terms are looking pretty good. So that's great, and banks are especially direct lenders are very, they're trying to get capital to work just like private equity. So PE multiples remain strong. They've dipped a little bit, but they're still essentially at historic highs and above kind of the pre-pandemic levels. And then this year PE middle market activity is overall, all PE middle market activity is strong, but it's on track to be potentially this isn't the but it's on track to be potentially the second best year ever. I think already LTM is equal to or a tad better than 2022, but this data is a little bit deceiving, especially for all of us in the room here. And it's really because PE exits are down. And so PE exits remain depressed, but access to capital and valuations aren't the problem. So if you look at healthcare specifically, all healthcare deal activity is down this year. We're on pace. If you look at the first half of the year, we're on pace to be 10 to 15% down over last year. And that's, a lot of that, there's still capital being deployed in acquisitions, but private equity is buying three deals for every one that they're selling. And so it's really the exits that are depressed. And I think part of the reason, healthcare has been, with the policy, with the noise, everything we talked about before, healthcare has been, I think, more impacted than some other industries, and so that's why healthcare is down. When you look at healthcare services, PE has really pumped the brakes. The M&A in the second quarter, pretty much froze. If you look at Q2 '25, it looks like the start of the pandemic, when no one knew what was going to happen. Everyone pressed pause for a while to figure it out. Hopefully, we're about ready to rip it like we were coming out of the pandemic. But I think there was so much uncertainty in the market. Everyone was running from anything with, Medicaid exposure, reimbursement exposure, and some of the new, both federal and state, legislation and regulations around healthcare. So there were a few bright spots in healthcare. Our team's been all over areas like autism and some subsegments of behavioral health. Infusion has been very hot. Med spa has been very hot, that area. And then, a lot of investors are looking for areas of non-discretionary health spending into the healthcare system. So maintenance, repairs, validation, qualification, those sorts of things, those businesses where it's a highly regulated business. You can't not make this investment. You can't not make this spend. So those areas, and we've seen that in pharma services as well and across other areas of healthcare. So biopharma funding has slowed again. It was back on the rise through last year, but the first half, hit by the same issues that the rest of healthcare with uncertainty, and so it's dropped off quite a bit. But if you look at that, the 63.2 on an LTM basis through September, still on par with pre-COVID levels. So it hasn't totally evaporated. The IPO window is back. I look at the first half of this year. It's already done better than 2024. So things are looking great for the public markets, and I think some of that's just valuations have really swelled, and both retail and institutional investors are there in full force. Only 7 biotech IPOs so far this year, though, and that's versus the 4-year average of 70. So not a lot of biotech IPOs. We expect the IPO market and window to stay open into the new year. So I'm back, baby. All right. Anyway, had to put that in there. Thanks, man. We see, speaking of public markets, we see there's pockets of value in the public markets, especially in commercial biopharma. Our team's been involved in 2 successful take privates this year. We were involved in 2 other transactions where our clients, after they got in there, chose not to move forward on the transaction. But there's volume has been down a little bit this year, and I think some of that is also due to the noise. But we're tracking at Bourne. We're tracking there's about 50 commercial biopharma companies that are either trading at or below cash value or at or below around 1 times revenue. And so we think there's still some great opportunity there. And a lot of these companies need to be acquired or maybe sell off their commercial assets and focus on becoming get back to development, being a development stage biotech company. And there's pockets of value across pharma services and other areas within healthcare as well, and some of the public companies. So looking at sponsors, and I'm going to have to, we're a little behind, so I'm going to have to go a little faster here through some of these. But just looking at private equity funds, large private equity has dominated exits, and they, 80% of the deal values from larger transactions north of $1 billion. And it's always a larger percentage, but it's been particularly high this year. And correspondingly, larger PE firms greater than $5 billion have dominated the capital raising, and they accounted for over 60% of capital raised in 2025. So private equity fundraising has been tough overall. I think there's some really good firms that have been able to raise their next fund, but overall it's been tough. First time funds, really tough, and they've been declining, and they're on pace for another pretty significant decline this year as LPs have kind of stuck with larger, more experienced funds. But it's been tough all over. All funds have been tough. If you look at the rolling 12-month fundraising, it's down 40% year over year through the first half of this year. So LPs need to see distributions. They need to see exits. They need to see distributions before they re-up. So private equity portfolios are aging. You don't have exits. Your portfolio companies, they age. They get older. 70% of all PE portfolio companies have been held for more than 4 years. I don't have the stat in here, but I just read the other day that the average age of the PE portfolio companies is over 5 years now. And so these companies have to be sold. And I think come through some of the uncertainty this year. I think next year it's going to be a very, very busy year over the next 12 and 24 months. The global private equity dry powder is declining, and that's they're raising less. They're still deploying capital, but they're raising less capital, and that's once again LPs need to see capital return before they reallocate. All of that said, there's still a ton of capital out there in the market, plenty of capital. A lot of money chasing a small number of really great deals and assets, and that's keeping valuations up. I won't spend much time here. Just last couple things, and then we'll wrap up. So I'll fire through these. Even with all the pain biopharma has felt, biopharma R&D is still growing faster than GDP. It's resilient. Pipelines are still growing. So the market's still moving, and there's still a lot of great opportunity. Major headwinds in Medicaid. We spent a lot of time on this. The one thing that I like to point out here is $950 billion is a big number, but 76% of that is after 2030 and beyond. We'll have a new administration. Some of this may never see the light of day. There'll be a whole new deal before the majority of this even hits. But if it does hit, a lot of these healthcare services companies and providers would be operating in the red based on the impact to their revenues and bottom line. So something will have to be done there. Cost of care and health benefits is growing, and it's accelerating in its growth, and drug costs are a big piece of that. Our cost at Bourne, we have a average age of like 25, and our costs are going up 19% next year, which is ridiculous. And if you saw my stats last year, my stats are phenomenal. I'm very healthy. So anyway, it's not sustainable. Something has to be done here. I think we talked a little bit about this before. The favorable legislative treatment for biologic and orphan drugs. This is really interesting because over 50% of the drugs, new drugs being approved, are orphan drugs. And one big beautiful bill, as I mentioned, it's really beneficial there. But once again, it didn't. It failed to address the pill penalty and PBM reform. Pharma manufacturing, matter of national defense, already talked about that. So we're going to see more investments here, not only from big pharma, but also our pharma services companies who are building capacity here in the U.S. And then don't need to say much on valuation trends. It's kind of obligatory to have it in here since I'm the capital markets guy, but S&P has outperformed all of our coverage areas since we were here last year. I do think you get some more of this uncertainty cleared up. Pharma will be on the rise over the next 12 months. Pharma services has been depressed a little bit, more so by folks on the clinical CRO side versus CDMO, which is bringing that down as they've struggled in the markets over the past year. And this is just the 5-year trend. So pharma and pharma services, way down from their peak during early COVID days. But once again, S&P has continued to outperform. And a lot of that's AI driven in a couple of stocks that have been really bringing the S&P up. So what are the key takeaways? There's a lot of noise coming out of Washington that created uncertainty and held back the M&A activity this year, especially PE exits. The debt markets and the IPO window are open and multiples remain strong and at historically high levels. While PE has had difficulty raising new funds over the past 12 months, firms continue to invest and have more than ample dry powder to keep investing. There is a backlog of private equity-owned businesses ready and waiting to come to market. And if you look at our business, you look at our near-term pipe, Bourne expects a very, very robust M&A market in 2026. So that's all I got. Thanks. Oh, I do have one more thing, and this isn't like last year. I need to thank Van Pittman. He used to work for the bank. He works for Banks Bourne now on the family office side, but he helped tremendously in orchestrating and coordinating and pulling this together. Don Hooker, our head of research, helped with some of this as well. And then we had Nee, Will, and Eliza, 3 of our analysts who were working tirelessly and helping me while they were also very busy with their day job. So thank you very much. All right.